and it will be available in a few days in English, and then we are also going to get it translated into Spanish by Hugo Quinones of Quinones Translating. So we'll look forward to that. Let's go ahead with acknowledging the co-sponsors of this: Farmers Legal Action Group, Minnesota Farmers Market Association, Sustainable Farming Association, University of Minnesota Extension, Minnesota Institute for Sustainable Agriculture, Minnesota Farmers Union, and North Central SARE, Sustainable Agriculture Research and Education. So thanks to all of those who helped spread the word and get us rolling on this. I'm Jane Jewett with Minnesota Institute for Sustainable Ag. I'll be running tech in the background. Then we have Megan Roberts with U of M Extension, Stephen Carpenter with Farmers Legal Action Group, and Lindsay Keene with Farmers Legal Action Group, who are our presenters today. And they are all extremely knowledgeable, and we look forward to hearing what they have to say for us about the Paycheck Protection Program Part 2. So you guys take it away.
Thank you so much, Jane, for that introduction. Before we dive into Paycheck Protection Program first draw and second draw, we were talking and we thought it might be helpful to just do a quick refresher on the current disaster relief programs that are open and eligible for sign up right now, and then just compare and contrast that to the PPP program. You might be familiar and remember this summer and fall sign up for Coronavirus Food Assistance Program 1 and 2. That's a program run through Farm Service Agency, and you do need to sign up at a local United States Department of Agriculture Service Center. There is a current open period for CFAP 1 and 2 additional assistance. These are some modifications to the payment rates for the CFAP 1 and 2 program. The sign-up period and deadline is now through for February 26th. A note on CFAP 1 and 2. Currently, payments are paused on CFAP 1 and 2 through a regulatory review. We don't know when those will resume, but we do know that as of right now, February 26th still is the deadline for that program. There are also another sign up going on at Farm Service Agency for the Quality Loss Assistance Program, abbreviated QLA. That goes through March 5th. More information on both of those programs are available at the FSA's main farmer-focused portal, which is farmers.gov. PPP 1 and 2, that's what we're going to spend the next hour talking about. That is available for sign-up period through March 31st. Lindsay, when she presents, is going to dive a little bit deeper on all of those application details, and we'll repeat this deadline date at least once or twice throughout this program. But March 31st is your deadline for PPP first draw and second draw. SBA continues to also have economic injury disaster loans. This can get a little bit confusing. PPP and EIDL are sometimes confused together. The EIDL program is a separate program. It is a loan program without the possibility for forgiveness. And that has been extended for COVID through December 31st of 2021. CFAP 3 is something that we do not know the details on. It's important to note that CFAP 3 is a separate and distinct program from CFAP 1 and 2 additional assistance. As I mentioned, that's open now through February 26th, but we really don't have those details on if, when, and what CFAP 3 might be. So with that, let's dive deeper into PPP 1 and 2. Quick overview of the Paycheck Protection Program. This was something that was created back by the CARES Act in March of 2020. It's hard to believe that we started this process already 11 months ago. The first PPP was ultimately not super different from where we are right now in PPP. PPP has always been a forgivable loan to cover 2.5 months worth of payroll costs for small businesses, which includes farmers, impacted by COVID-19. Although the crux of the program, that 2.5 months worth of payroll costs, has always remained the same all the way back from March and April of last year, there have been changes, and the most significant changes to PPP occurred in late December 2020. And we're really going to focus in on what those changes were and how you can continue to access PPP funds now into 2021. As I mentioned, the Paycheck Protection Program is fundamentally different from the Economic Injury Disaster Loan Program. PPP is forgivable, meaning that if you use the funds for eligible expenses, you can apply to have that loan forgiven at the end of your covered period. An economic injury disaster loan is not going to be forgiven. It is a loan program. It does have really favorable rates, and it is an option for small businesses impacted by COVID, but that is going to be a loan that you do pay back to the Small Business Administration. Now, because of that December 2020 update, we have two types of PPP. They have named them first draw and second draw. First draw can still be applied for if you haven't received a PPP previously. That's supposed to say loan. I apologize for that typo. If you haven't received a PPP loan previously, or if you could increase your PPP loan amount using your gross income instead of net income, you want to start here with first draw. If you have already previously received PPP and made sure that you don't qualify for an increase in your first draw PPP loan amount, you can look at the second draw. A second draw has some special requirements though. You do need to show at least a 25% decline in receipts in at least one quarter of 2020 as compared to 2019. Throughout today, we're going to talk about the first draw and second draw. We will only split it out into the first and second draw categories though, if there are different rules based on first versus second. If the rules are the same, regardless of whether it's first or second draw, we'll just talk about PPP more generally. One of the things that we've tried to do throughout this webinar series is apply some myth busting to these various COVID relief programs. When it comes to PPP, one of the myths is that you can't apply if you have very low net farm income or negative net farm income. This was indeed somewhat of the case in the previous iterations of PPP, meaning if you had negative net farm income, you could not qualify if you did not have employees. And if you had very low net farm income, it might not have been worthwhile for you to go through the process. In this new iteration of PPP, Schedule S filers, which are generally farmers, do have the ability to apply utilizing their gross farm income. We'll talk more about this. So don't think PPP isn't for you just because of a negative or low net farm income. You can apply for PPP even if you don't have employees, because you as a self-employed individual are essentially your own employee. And you would apply for owner's compensation recoupment. Seasonal farms can apply. So it's a myth to say if your farm is seasonal, you can apply. You actually can. This is designed for small businesses of any size, from very small up to the maximum of what the US government defines as a small business. So I have looked at the PPP data, and there are literally folks in Minnesota that applied for PPP in the hundreds of dollars, thousands of dollars range. You do not need to be a large farm in order to qualify. You might not want to have debt. While it is true that PPP is a loan, it can be forgiven. And most folks, if they follow the directions for eligible uses, will be able to have a forgiven PPP. Finally, isn't it a lot of paperwork? Well, that is a matter of opinion. That's a question that you'll have to answer for yourself. But most farms that have been through the process find it to not be too burdensome. And with that, I'm going to hand it off to Lindsay, who's really going to dive into the details of the loan application.
Okay, thanks, Megan. Hello, everyone. My name is Lindsay Keene. I work with the Farmers Legal Action Group along with Stephen. And I'm going to do my best to help walk us through the various eligibility rules that apply, regardless of whether you are applying for the first time for a first draw PPP loan, or if this is your kind of second bite at the apple, so to speak. And just a couple preliminary things. I'm going to try to keep this general, because if we get too in the weeds, I think it's going to get extremely complicated. But I would encourage you to use the Q&A box if you have a specific question about your farm or your situation, and we will do our best to answer them. The other thing I would just say, maybe a kind of a tip, it can get confusing because of the new laws in that we now have essentially 2 tracks for PPP. So as I'm going through, I think, the best way to keep things straight in your mind is to just have a sense now of which track you would be on. If this is your first PPP loan, then you really want to pay attention to those first draw loan rules. If this is your second, then really pay attention when we mention second draw loans in particular. So with that, I'm going to dive right in and again, just ask questions as they come up. So to begin with, there are some basic eligibility rules that apply across the board for both first and second draw loans. And that is, what types of businesses are eligible for these loans. So there's a wide variety. Many of these have existed since the program started in 2020. So you can be a tribal business, a nonprofit, a veterans organization, a partnership. You can be an agricultural producer, so a farmer or a rancher. And that means you can be self-employed, a sole proprietor, or an independent contractor. So all of those businesses and individuals would be eligible. And then in addition, the Economic Aid Act that was passed in December of 2020, it added some new types of businesses that are now eligible for the first time. And these are housing cooperatives, also 501c6 organizations, destination marketing organizations. So that's a lot of like tourist bureaus. And then there are certain news organizations. So I don't know how many of those will apply to this group, but just wanted to point that out. So those are the eligible types of businesses. In general, you need to have under 300 employees. Now, if you are applying for a first draw loan, there, the max can be 500. But again, I don't think that distinction is going to be as relevant to this group. So, so I would keep in mind fewer than 300 employees. Another important aspect of eligibility is that you need to have been in business on February 15th of last year. But one caveat with this, if, as Megan mentioned, seasonal employers are eligible. So let's say you have a seasonal business and you were dormant on February 15th of 2020. You can still apply for PPP if you were active for any 12-week period between February 15th of 2019 and February 15th of 2020. So just keep that in mind. And then finally, the general rule is that you can only apply for one first draw loan and one second draw loan. And towards the end of my portion, I'm going to mention an exception that applies if you are trying. There's some narrow exceptions for folks who can apply for a recalculation of their first draw loan, but we will talk about that later. So I would keep in mind for now that you can only apply for one of each. And a key aspect of that is that if you had a first draw loan, you cannot receive a second draw loan until you have completely used all of your funds from that first loan. So I think that's an important point to make. Okay, I think we're ready to move on to the next slide that should deal specifically with rules for second draw loans. So again, this is just for second draw. As I mentioned, you have to have already received a PPP loan and you have to have used the entire amount on eligible uses. And that must be, all of those loan funds must be used by the time, and this is where it gets a little wonky, but by the time the second draw loan is dispersed. So there is sort of this gray period where, if you think you might be able to use your first draw loan funds in the next couple of weeks, you could potentially apply now. assuming your second draw loan funds wouldn't be dispersed before then. I would just say on that, I would work with your lender to work out the timing. But in general, just think, don't apply for a second loan until you've used your first. And the other requirement, this will be kind of a repeat of what Megan mentioned, but for second draw loans, this is a new requirement. You need to show a revenue reduction of at least 25% in 2020 compared to 2019. And just a couple additional points on this. You know, SBA has created a variety of rules that allow you to demonstrate this reduction in numerous ways. So, you know, if you weren't in operation for all 4 quarters of 2019, there are different ways. You know, you can choose any quarter from 2020 to compare to any quarter that you were in business in 2019. So there's, you know, if you have questions about this rule, I would suggest asking your specific question in the Q&A and we can answer it. But the other important thing I would just note is that if you're in operation where you don't generally keep track of things quarterly as much as annually, it is possible to use your annual tax returns for 2019 and 2020 to show the reduction of 25%. So that could be helpful for some folks who file their Schedule F, for example. So, okay, so those are the main eligibility rules. Next, we're going to talk just briefly about some of the things that might make you ineligible. And there are more rules than I have listed here, but these are kind of the big ones. So the first is that you are not eligible for a loan if you are delinquent or in default on any federal loan. You also cannot apply for a PPP loan if you're engaged in any sort of illegal activity. There's certain rules on if you have been incarcerated or on probation that also apply in this category. SBA also says that if you're a household employer, and it gives the examples of, you know, maybe you employ a nanny or a housekeeper, you cannot apply for a PPP loan based on those employees. As well, we have certain bankruptcies, and I think the key with this is that if you're ineligible, it's only true because you're presently involved in a bankruptcy or you become involved in a bankruptcy before the loan funds are dispersed. So if you had a bankruptcy years ago and it has been resolved, that should not be a bar to your PPP loan. The rules limit it to essentially current bankruptcies. And then finally, if your business has permanently closed, you are not eligible for a PPP loan. Now, if it's something where you had to temporarily close, but you intend to start back up, that is a different story, and you should be eligible. So really, we're just concerned about if you closed your doors and you are not reopening. And finally, I would just note that there are some of the ineligibility rules also apply specifically to second draw loans. I won't get into too many details on them, but one that may or may not affect some people is that if you have a business that is heavily involved in lobbying or political activities, you would be ineligible. And then there are some, you know, I would say more obscure ones dealing with, you know, relationships with China and things like that. So again, if you have questions on ineligibility, throw them in the Q&A box. Okay, so moving right along. So let's imagine, you know, you get past the bars to eligibility and you are a business and you think you're eligible. The next question is what you can use your PPP loan for. And this is important because technically SBA can ask you to repay any amount of the loan that you don't use for eligible or allowable purposes. So when you're considering whether to apply, I would think through whether, you know, these funds could be used for the costs that are listed here. So the first big category are payroll costs. And again, you know, the intent of the PPP program is really to help offset some of those costs. So this can include salaries, wages, tips, a variety of similar types of compensation. I would note that amount of compensation is capped at $100,000 a year per employee, if that affects anyone. The other types of things that are included in payroll, so any sort of group health coverage, it could be life, disability, vision, dental, that would be covered, retirement benefits, as well as a variety of types of leave, so vacation, sick, parental or family leave. So all of those would fall into the larger category of payroll costs. In addition, if you are self-employed, you also, and Megan mentioned this, essentially the rules are designed to create an owner compensation replacement. So you are able to use the funds for your own income and your own wages. And we'll talk through a bit later how that's calculated, but just know that that's possible. In addition, there's a variety of business expenses that you can use the PPP loan funds for. These include mortgage interest payments, any payments for renting or leasing your farm. It could be farm buildings or wherever that workspace is, and also various utility payments for electricity and internet, for example. The key with most of these expenses is that the obligation for those expenses needed to have existed by February 15th of 2020. And what I mean by that is, let's say you are, leasing a building where you're working. That lease needed to have begun by February 15th of last year, if that makes sense. And the same for all of these types of business expenses. And then in addition, and this is one area that the Economic Aid Act from December of last year really expanded the program. And there's now 4 other categories of expenses for which you can use your PPP money. So these are what they call operations expenditures. And essentially that category is referring to any sort of business software that facilitates your operations. So that could be business software that helps with your sales and billing, your accounting, your payroll. So a variety of operations that you're using that software for. You can also use the PPP funds to cover some property damage costs, but specifically, this is about damage or vandalism that occurred due to the public disturbances in 2020. And importantly, the PPP will only cover those costs if your insurance, for example, did not cover that. In addition, there's a variety of what SBA is calling supplier costs. And these are defined as costs that are both essential to your business's operations and costs for which there was a contract or purchase order in place already. So it needs to be an existing contract. And then finally, SBA has created a category that they're calling worker protection expenditures. And these cover both operating and capital costs for things that you have needed to do in order to comply with any of the COVID-19 regulations for sanitation or social distancing, worker safety, or customer safety. So I feel like that was a huge mouthful, but I think it is really good and important to keep in mind what you can spend this money on. And as Stephen will talk about later, when it comes to whether or not your loan can be forgiven in full, part of that is necessitated by how you've used the money. So being sure that you're using them for these reasons is very important. Okay, I think, so that kind of gets over the key eligibility, how to use the loan. The next big question that people often have is, how much am I gonna get and how do I figure out how much the loan might be? So the general rule, and Megan mentioned this at the beginning, is the program is based on designing a loan that is roughly 2.5 times your average monthly payroll, or for self-employed people, it would be 2.5 times your owner compensation replacement. And specifically, and importantly, as Megan mentioned, for Schedule F filers, the way that owner compensation replacement, what is looked at is line 9 of your Schedule F. So that's your gross income. So that is a big change that we anticipate will help many more farmers be eligible for the program. If you are a Schedule C filer, they will look at net income from line 31 of Schedule C. So just to point that out. So now I'm going to attempt to walk through a few examples of how a PPP loan might be calculated. And I will do my best to make this as simple as possible. So the first category is we're going to talk about a self-employed person who has no employees. So essentially, you're a sole proprietorship. And this calculation more or less is going to apply for both first and second draw loans. So what you would do if you are self-employed with no employees to calculate your PP loan, you're first going to be able to choose either your 2019 or your 2020 Schedule F or Schedule C if that applies to you. So this is a change. Previously, there was a focus on 2019, but now you get to select either. The important thing to keep in mind with this is whenever you're selecting a year, you have to use all of the data from that year. So you can't kind of pick and choose some from 2019 and some from 2020. So once you've selected which Schedule F, which year you're going to use, then you simply look at that line 9 for gross income. You would divide it by 12, which would equate to what SBA is figuring is your average monthly gross income. And then you're going to multiply that by 2.5. So that is kind of what your PPP loan amount would be if you're just curious at getting that estimate. The one caveat, so that calculation applies for both first and second draw loans. The only difference is that if this is your first time applying for a PPP loan, so you're applying for a first draw loan, if you wish, and if you have any outstanding balance or any outstanding amount of an EIDL loan that was made last year between January 31st and April 3rd, you can add that in and essentially refinance that loan into your first draw loan. This would not apply to second draw loans because presumably you already had the opportunity to do that. But again, that is just an option. So keep that in mind. Okay, the next one we're going to go to is, I debated whether to put it in because it's a little wonkier, but I think it might apply to several folks. So I'm going to do my best and just ask questions. So the next one is if you are self-employed, but you also have employees. So maybe you have 2 or 3 employees who work on your farm. How do you figure out your loan amount? So the first thing, you're going to choose that Schedule F from either 2019 or 2020. And then you need to calculate the payroll amount. And what I want to emphasize here, I have tried to simplify it down, but SBA has a lot of details and we can direct you towards resources that really spell out exactly which lines of your Schedule F to look at and how to get the precise calculation. But the point I want to make is SBA is trying to account for both your owner compensation replacement as a self-employed person, as well as the fact that you are paying for employees. So in trying to account for both of that, what they have come up with is that you are looking at 3 categories of things to determine your payroll. The first is the difference between your gross income from line 9, and then you add together 3 other lines from Schedule F, 15, 22, and 23. And so that would be the first category, and that's supposed to represent your owner compensation replacement, taking away any payments for employees. So they want that to really just represent you. Then next, you have all of the expenses, your typical payroll expenses for employees. So any of the wages and tips you pay to your employees and any contributions to those categories of benefits such as health coverage or dental or vision and retirement. So that is the first thing. So then what you do is once you get that amount, and again, we can direct you to more specific resources for that. When you're trying to figure out what your loan would be, you would take that amount, divide it by 12. Again, our goal is to get, what is the average monthly payroll? And then you would multiply that by 2.5. And so that will give you the base amount of a PPP loan. The same caveat applies for this, where if you are applying for a first draw loan, you could also refinance part of an EIDL loan that you received last year if you wish. So I hope that was more or less understandable. And finally, we're going to go to an easier one, and that is if you are applying as a seasonal employer for a first or a second draw loan. And with this, the important part is that you can select any 12-week period between February 15th of 2019 and February 15th of 2020. And then you're going to take your average monthly payroll that you've spent on employees during that time. You're going to multiply by 2.5. you all are getting the theme by now. And then you have your PPP loan amount. And once again, you can refinance an EIDL if you wish, if this is a first draw loan for you. So that is the quick and dirty on what the loan calculations look like. So the final thing I am going to talk about, or at least quickly mention, there is kind of this bizarre aspect of the changes to PPP that in very narrow circumstances allows some people who previously received a PPP loan, and under the SBA rules, if you've already received a PPP loan, they're just calling that a first draw loan. So if you already received a first draw loan, there are certain circumstances under which you can either apply to have your loan increased if the new rules would allow for that, or you could actually reapply for the loan. So I'm going to talk through these real quickly, and feel free to ask us questions later if you're wondering if this applies to you. But the first and maybe most relevant is that if you are a farmer or rancher who did qualify for a PPP last year, but you would actually now, under the new rules that allow for gross income, you would now be eligible for a larger PPP loan, you are able to apply for an increase. The same is true for seasonal employers. If you applied last year, you received a loan, but now you look at the rules and you realize that, oh, now that I can select any 12-week period, I could actually get more. You can also apply for that increased amount. In addition, there's a rule that allows partnerships who did not previously account for partner compensation, they can apply for an increase. And then a couple kind of more obscure rules. If you received a loan but chose not to accept it in its entirety, or you returned some of it, you may be able to request an increase up to the amount that you were originally approved for. So those are the circumstances under which you can increase your amount. And then there's one situation in which you can actually reapply for a first draw completely under the new rules. And that is if for whatever reason you received or you were approved for a loan last year, but you returned the entirety of the loan before December 27th of last year. So I'm guessing that's more of a rare situation, but if that is the case, that is the one time that you can reapply for a new PPP first draw loan. And the way to do this, the important thing to know is that you have to use the same lender that you used the first time, and only the lender can submit the application, which is similar to applying for a PPP in general. So my advice would be, if you think that you might be eligible, is to contact your lender and work with them. And the only other thing I would note is just to keep in mind that the rule that you cannot receive second draw funds until you have used first draw funds, it applies to any increase. So if you are planning to apply for an increase, you won't be able to get any second draw funds until you have used all of those increased funds. So I would just keep that in mind if you're deciding kind of what approach to take. Okay, so I think that is it on the kind of big category of eligibility.
Lindsay, I know that we've addressed it in another area, but I just want to add to this slide that for eligibility for an increased first draw PPP loan, you couldn't have received forgiveness prior to 12/27. So if you applied for forgiveness and received it back in 2020, unfortunately, you're not eligible to increase your first draw, but you'd still be eligible for a second draw.
Thank you. That's a hugely important point. So I don't know if we're going to wait to do Q&A at the end, or...
we have a lot of questions coming in, and we don't have really a large amount of the presentation left. Do you think we should keep going and do a rapid fire Q&A at the end? Does that sound okay, Jane?
Yeah, I've been compiling questions as they come in. Stephen's been answering a few of them in the Q&A. So why don't you just continue with your presentation so we don't knock you off stride, and then we'll, yes, there are a lot of questions. We'll get to those at the end.
Sounds good. Well, we will keep going. Hopefully we're answering some of them as we move through this presentation, but we're definitely leaving time at the end for questions. This section I'm going to go through pretty quickly because Lindsay has already done a really excellent job of walking us through the application. Generally, these are the forms that you would need to fill out an application. Your 2019 or 2020 Schedule F. We do have some that fill out a Schedule C, so then you would obviously need to use that form. If you have agricultural employees, generally you're submitting that information via the IRS Form 943. If you make pre-tax benefit contributions, this can be helpful as well if you have employees. And the SBA website, as long as you're able to navigate it, there's so much information on there. If you can find the info, SBA really does do a good job of walking you through it. So I encourage folks to look to the SBA website. We're finding that lenders really know a lot about PPP. We're not in the early days of this program anymore, so they are also helpful. I've heard in PPP second draw that some lenders actually were really the ones initiating conversations with their farmers, not the other way around. So lenders can also be a great resource as filling out these applications. So without employees, if you are a non-Schedule F filer, then previously line 34 was key. But things have changed, as Lindsay mentioned, and now in my big, bold, ugly circle here, we have line 9 circled, because if you do not have employees and you fill out a Schedule F, we are now looking for gross income. If your gross income is more than $100,000, you are maxed out at using that, and then dividing by 12, multiplying by 2.5. If it is less than 100,000, you take the exact number from line 9. Your Schedule F is also going to have other information that would be helpful, like your employer ID number and or your Social Security. And then with employees, Form 943 can be very helpful. But even on your Schedule F, you have a lot of that information in line 15, line 22, and line 23. So that's what we've got circled here. You can find this information also on the SBA website. And as I mentioned, many lenders can help walk you through this as well right now. So let's do some math. If line 9 of the Schedule F was $113,000, we had gross income, and you have no employee payroll, then it's just simply annualizing our income to 100,000, dividing by 12, multiplying by 2.5, and the absolute maximum that an individual without any employees could receive for a PPP is $20,833. That would be what you request for your PPP, and you would move forward with that number. Pretty simple. This is in contrast to the old math, where previously, if line 34 of the Schedule F was $42,000, because we had $58,000 worth of expenses that we had deducted, you would have had to use that lower net farm income amount. And so you would have received a much smaller amount of PPP. If these two examples are the same farm, that farmer can go back to their lender and request an increase on their first draw, the difference between their previous smaller PPP loan and their new, more expansive PPP loan. And this just fits with the information that Lindsay already presented. When it comes to a second draw application, though, we've got a couple extra steps. First, we have to meet all of the parameters set forth for applying for a first draw, using it up, and then looking at the second draw. Then we would need to, on our application, provide that information, which Lindsay already referenced, that shows a reduction of 25% of at least 25% of gross receipts. And they're going to ask for that information right on the application. This is a screenshot of the SBA application, but note that lenders can use their own forms and many have created their own online portals for PPP. So you may even be asked to submit additional information to meet lender requirements. But this is the bare minimum that SBA is requiring, and you will need to prove this in order to be approved for a second draw. When thinking about successfully applying, remember you are working with lenders, not directly with the Small Business Administration. Most of the documentation that you need is going to be directly available on your previous year's tax documentation. Even though a lender might be using their own forms, you can go to the SBA website and look at their applications. You can even do a test run of filling out the SBA application, and that's going to help you know the information you need ahead of time. Advocate for your eligibility. I know that some of the questions that we have had is, how do I work with a lender through this? Or I haven't had a lot of success with my lender. Maybe you need to work with a different lender. Although, as Lindsay mentioned, if you've already started the process with one lender, you need to follow that through for your first draw and second draw. And then finally, don't wait until March. It's so easy to see a deadline and wait until the last day. Make sure to give yourself time in order to fill out this information. I think we're past the point where there's the conception that ag is not eligible. Most lenders do now understand and work with farmers on this program. If you don't, though, have an existing relationship with a lender, that's where it can be a lot more difficult. Some prefer to work with existing clients. Perhaps they do not have accessible applications in your language of choice. If that is the case, remember that there are many lenders that are looking for help, and there are organizations like us and Extension and others that are helping with this webinar that are looking to try to help farmers through this process. SBA even has created a free matching service where you can look for local lenders in your area. So that is available at this website. And if you're still pondering where to go, if you have fellow farmers in your network, perhaps they'd be willing to share who they worked with. Did they have a good experience? That might be a good way to know that you're headed in the right direction. Again, I think we're waiting for questions until the end. And with this, I'm going to hand it off to Stephen, who is going to wrap up before we move into Q&A.
Hello there. I'm unmuted, I think. I hope. Okay. Let's assume that we have our loan. Now we're interested in figuring out what we're going to do about forgiveness, because we'd like to figure out a way to make sure that this loan doesn't need to be paid back. So I see that we have a slide up of documentation. This is actually good. We'll come to this just in a second. So in general, as we know, we have this sort of confusing difference between a first and second draw. And so one thing to remember is that they are pretty much the same. So it may be true that the second draw debt forgiveness requires a little more documentation, but in general, the rules are very, very similar. So here's the deal. You will remember that there's such a thing as a covered period, that this is the period in which you are spending money, spending the loan money, and they call that the covered period. And so that covered period is going to be important in deciding what gets forgiven. And that covered period begins the first day that your loan is dispersed, the day you get it out. And actually you can't delay forever to do that. You can't sort of game the timing of it. The lender has to give you the money within 10 days. So there's a little flexibility there, but basically soon after you get approved, you're going to be getting this money. And so that begins your covered period. Then you get to choose how long that covered period is, as long as it's 8 to 24 weeks. And so you can You can make it shortish at 8, you can make it longer at 24, but you can't go outside of those. And it's important to remember that the first and second draw can't overlap with their covered periods. So the first big question is, what kind of expenses can be forgiven? What is it that you can spend money on that will eventually be forgiven? And so what SBA does is set out a certain number of things that you can spend money on, and they're very, very similar to the eligibility uses that were already discussed earlier. And so is a very general rule, if you spend money on in the right proportion on the things that you're allowed to spend them on, as long as the bulk of it is payroll, the loans are going to be able to be forgiven. So the first big thing that you can spend money on that's going to qualify for forgiveness is payroll. And so for people who have employees, that's mainly self-explanatory, right? I mean, you have payroll expenses that are incurred or covered during incurred or paid during your covered period. So that means either your employee, did the work or you paid them. And so that's wages, salary, tips, costs, benefits, vacation. That's all sort of covered as employee type expenses. If you're self-employed, they have a name for that. It's called owner compensation replacement. And so that essentially, you don't have to have written yourself a check to qualify for this. If you're self-employed, you're going to be sort of in the payroll expenses sort of essentially automatically. And that is going to be based as was described earlier, either on your Schedule F or if you use a Schedule C, your Schedule C. It's based on your gross profit from 2019 or 20, not more than $100,000 annualized. And so if you are self-employed, we start thinking about, okay, what is the equivalent of this employee compensation? Basically, this is what they try to do. They say that you're going to be, if you say do for 8 weeks is your period, they're going to prorate you based on your income from your schedule, your gross revenue from Schedule F, up to those 8 weeks, and they're going to max you out at a roughly $15,000. If you go longer, and again, if you extend your period out to say 24 months, you're likely going to get, you're going to be in a position to get a bit more money, but that itself can also be maxed out at something under 21,000. So you'd have to do, there's a little bit of a calculation there, but the thing to remember is that if, for your self-employed, what equivalency of a payroll is really going to come from your Schedule F that we've already discussed. The second thing you can spend money on is what they call non-payroll expenses. And so the logic here is that you can spend money on things for your business that you could use as deductions for your business on your taxes. And so that's kind of what all these things have in common. And again, Lindsay would explain the sort of things you're permitted to use the money on. Well, it turns out those match up quite well with what you can use it to have it forgiven if it's in the right proportion. So business mortgage interest, that's perfectly fine as something that can be forgiven. Of course, that's a big thing for farmers. And it's important to remember that's not just mortgage interest. If you have a real estate loan, it's also loans in interest on personal property. So if you've got an equipment loan, an input loan, whatever, right? If that's generating interest, that's something you can spend this money on. If you have business rent or leases, that's another thing. And again, obviously farmers have a lot of leases, and that's can be for equipment as well. Lindsay mentioned business utilities. Again, that's sort of a normal thing for even the smallest business. But for example, if you're doing dairy, obviously electricity can be a super big thing, and other people too. but it's a sort of thing that can be a substantial expense, and you can spend your PPP money on it, again, if it's in the right proportion. Covered operations, things like business software, Lindsay mentioned, and property damage costs. If you were doing urban farming in Minneapolis and things got destroyed over the summer, actually that's something that you can count money towards as well. Covered supplier costs are the sixth thing. And again, here's one thing that for a lot of small businesses, okay, sure, there's a cost there. But as I read these rules, I think that's for many, many farmers, a substantial expense that you can put this money to. So that's going to be buying grain for livestock. You can picture buying hay, seeds, other inputs for your farming operation are going to qualify as something you can use and have it forgiven. Also, if you spent money on worker protection, that's something you can spend this for and have it forgiven. So those are the possibilities. And the basic rule is that to get everything forgiven, or as much as possible, as the slide shows, you need to spend 60% on payroll or your sort of owner compensation. And that is sort of the biggest hurdle. Along with that, though, if you do have employees, they have rules that make sure that people don't radically slash their employee payments and then still keep get the loan forgiven. So the wages have to stay within 75% for every single employee. So you can't take a certain employee and drop them to 25% of what they were making. Everybody's got to be within 75%. There are exemptions to these rules. I mean, that can help you. So if you reduce somebody but then bring them back, that you will still qualify. So you can't radically reduce people's wages. For the total operation, your full-time equivalents, like how many people do you have working a total of how many hours, you've got to keep up over this entire period. And so they want to basically say you compare with the period, your so-called reference period of the time before, and you've got to keep that full-time equivalent within about 80%. And as with is also the case with keeping your wages at 75%. This is not an all or nothing thing. In other words, if you just barely fall a little bit off the 75% with wages or the full-time equivalent, they're not going to dock you the entire forgiveness. They're going to sort of dock you dollar for dollar. So if you have 80% of full-time equivalent, not 100%, well, then you get 80% of the loan forgiven. It doesn't suddenly drop to zero. There's some exemptions with the full-time equivalent rules as well, and they basically revolve around, well, do you try to restore hours? Did you try to hire people? Did you try to replace them? Were you forced to fire somebody for cause? You can imagine, I mean, they're trying to give you a little bit of flexibility if you really didn't have any option at all. And including, for example, if it was simply unsafe for people to work. Like say you have a retail, you had employees at a farmer's market and the farmer's market shut down and nobody's operating, then that's a way you can sort of get around this FTE requirement. So how do you go about doing this? Naturally, this being the federal government, we have forms, and the forms have names that seem to come out of a science fiction movie. So there are three different types of forms. Your super standard one is, you see in front of you, form 3508. So that's the one that sort of larger businesses are going to use. It's going to be more complicated. You'd really very much like to avoid that. The so-called simplified form, 3508EZ, you can use if you have a loan of no more than 50,000, and you haven't reduced wages or workers or salaries by 25%, and you've not reduced employees or hours. In other words, it's simpler. It's going to be easier in some respects, but the one you really want to do if you're farming is so-called 3508S. And For that one, you can do that if your loan is for less than 150. No documentation is required. Now, what's going to happen is you're going to have to certify that these certain things are true, but you don't have to produce the documents then. I want to really warn people, though, anytime they say you can certify, what they're also saying is you have to have the documentation to back it up, and don't throw the documentation away because they can come back later and ask you for it. For this so-called S3508S form, it's also the case that if you haven't already done a revenue reduction when you applied, then you have to do that now. So with all of your documentation, you really need to keep it. With a 3508, you don't have to submit it, but you really need to keep all of your records on kind of obvious things like your employment costs and the like. If you're spending money on buying hay, you need to like keep those records. The question might be how long. I mean, you look at the rules and they talk about 6 years, but I'd say that should be a minimum. So how do they decide who gets the loans forgiven? It's actually mainly your lender, and SBA can review what the lender does, but it's really going to be mainly in the hands of your lender. They have 60 days to make a decision after you apply. They may forgive everything you want forgiven, they may forgive some of it, or they may deny you completely. And that's going to depend on whether they think you qualify based on these rules. If you don't get everything forgiven, then you're back to making payments, and you need, as you will remember, it's 2 years essentially, and you have those terms that it just becomes a regular loan. Just a couple more things. One is that there's a weird question, an important question about taxes. So the IRS thinks in this world that if you borrow money and get it forgiven, that's taxable income. And the IRS is very adamant about that. Now, it's quirky in the sense that there are weird exceptions to that rule. Farmers have their own special exceptions. So all else equal, someone forgives you a loan, that's federal income. However, the CARES Act and later acts by Congress say that this loan forgiveness is not taxable. But please be alert, first of all, we're only talking about federal income tax. State income taxes are a different matter. And Megan and I were talking, and she understands Minnesota, if you're in Minnesota, taxes to include for debt forgiveness as well. And I haven't looked it up, but if you end up with a problem with that, or you have an accountant that doesn't understand it, we could try to point you in the right direction there. The last thing I'd say about the tax question is the IRS has made a ruling that says that if you get debt forgiveness for an expense, let's say electricity, you can't turn around and also claim that electricity expense on your taxes as an expense. And so if you think about it, it makes sense. You didn't in the end have the expense. You didn't have to pay it. So they don't want you to use that as a deduction on your taxes. Quickly,
with the
to
exception
finish up,
of PPP. With the exception of PPP, with that having changed on December 27th for just PPP. But of course, that remains the case for other debt forgiveness.
Stephen, you're muted.
Oh no, Stephen, you're now muted. That's because I interrupted you and he was so nice and muted himself.
So there is an appeal system for the PPP, but it's not everything that we would hope for. So basically, Small Business Administration has an appeal system, and you can appeal decisions, but only decisions that are made by SBA. And so if your lender denies you and SBA is not involved, it's not clear whether you have a very good remedy or not. And I think in the end, you could probably sue your lender to say that they should have ruled for forgiveness. But that's nothing that's really going to be easy. Really, if SBA is involved in the decision, you can appeal that decision in some cases. But if not, you're probably going to have a hard time. And even then, if SBA makes a decision, it's got to be about eligibility for the loan, whether they somehow say you weren't eligible after the fact, or about some debt forgiveness issues. So if you're familiar with some of the other federal government entities that have a decent appeal system, it's looking like this is a weaker system than that. The last thing I wanted to talk about just for a second is about discrimination. So we're used to thinking often that all farmers are white men. We know actually, of course, that's not true. And one of the ongoing problems in agriculture we have is discrimination against people based on race, ethnicity, gender, etc. And in these PPP programs, no one's really gone to much work to figure out what might constitute discrimination or what you can do about it. But what I would say is this, that there's something called the Equal Credit Opportunity Act. It's a federal law, and it prohibits discrimination on a credit transaction. And here we're all this whole hour talking about credit transactions. So we know discrimination is wrong, but also under the Equal Credit Opportunity Act, it's illegal. I don't know if anybody's explored this very far, but if you feel like you're being exposed to discrimination, there may well be a legal remedy. The very last thing I would say is Lindsay and I are working on a guide to these new PPP rules. We're not finished yet, and it's going to be very detailed. You can look up every possible rule. It's going to be on our website. We've done a number of these on other COVID-19 issues in the past. If you go to our website, you could spend weeks reading things that will certainly be dry as dust, but hopefully they're useful. And what you're hearing today, you'll get a much longer, more detailed version of on our website. And with that, I think we're wrapped up. Are we going now to questions? What's next?
Yes, we are going to questions, and there are a lot of them, and I'm not sure we're going to get through all of them in the like 11 minutes remaining. So there are a couple options. We could run this webinar long if people are able to stay on. We could have you presenters do a written Q&A based on the questions that were submitted. I know Megan did some of that in the past. So if the presenters are game for that, we could get out some written responses afterwards. But for now, let's just go ahead with some questions and see how far we get. So I'm going to go back to a few of the eligibility questions. And if I don't get to yours, I apologize because there was kind of a flood. We'll get to as many as we can right now. Okay, so here's one. I quit my off-farm job and went into full-time farming on February 28th, 2020. So I made more dollars in 2020 than in 2019. So it sounds to me like my farm is not eligible for a PPP.
Yes, I would say if your business, the farm business wasn't in operation on February 15th, 2020, that unfortunately you are not eligible. And Megan or Stephen, if you read the rules differently, please chime in.
February 15th is certainly an important deadline. If you were part-time farming previous to that, you could still apply. And for first draw, it does not matter if you made more money in 2020 than in 2019. That's a second draw requirement. So first step, if you weren't in business on February 15th, moot. Second, if you were in part-time business by at that point, you could still possibly apply for first draw.
Okay, there's a related question about someone who purchased a Christmas tree farm in October of 2020, sold trees and will be filing a Schedule F. Are we eligible for PPP loan and forgiveness?
Can you repeat?
Lindsay,
I was just going to say, can you
Lindsay, I
repeat
think
that?
you had answered this question. If it was purchased in October of 2020, you haven't met that February 15th deadline, unfortunately.
Okay, thank you. Here's one that I'm not sure got answered in chats or Q&A. What if we had to file personal bankruptcy due to COVID? The business was not included in the bankruptcy. We are past the 6-month window. Are we eligible?
I think we did answer that question, but the answer is that if you're not in, if the person applying is not in bankruptcy at the time of the application, or any time between then and when the loan is made, it's okay. So as I remember, this was a sort of a long ago bankruptcy, or a couple years ago. So my understanding is that that person could still be eligible.
Okay. Our outstanding bills to vendors, bills we haven't been able to pay as a result of lost sales due to COVID, are those eligible for PPP? Related question, do the eligible covered supplier cost expenses include past or current supplier expenses or both?
So for the first part of the question, one of the, and I don't think this was in my list of eligible uses, there is, if you have interest payments on any other sort of debt obligation that was incurred before February 15th of 2020, that is an eligible use. I think one of the keys is, I don't believe that's eligible for forgiveness. So there's a couple wonky rules in there where an allowable use is not eligible for forgiveness. But yes, interest payments on other debt obligations, as long as that obligation was in place before February 15th, 2020, would be an allowable use of a PPP loan.
The other key is the incurred or paid aspect of it. And without getting too detailed, a lot of this is spelled out pretty nicely on the forgiveness applications. So it kind of depends on the specifics of your situation and exactly how those invoices are coming in when they come in, but incurred or paid during the period would be the general home run for being able to use it for forgiveness.
Okay. Yeah, there are questions that may require some more detailed one-on-one follow-up. And if that's the case, we'll do our best to get you connected. Am I eligible to receive a PPP loan for my dairy farm if I'm getting unemployment insurance for my sideline construction business?
I don't, the question here probably is not about eligibility for PPP. I don't think the PPP rules would stop you, but the state unemployment office might have a concern that you also have other income from self-employment. So I would be super careful about state unemployment people thinking that you're sort of double dipping or not reporting all income. But I think from PPP, the perspective, nobody's gonna be concerned.
Okay, that kind of rolls into another question, or a couple of questions. How to stay out of trouble in future audits. And then does the 8 or 24-week period for eligible expenses start the day the loan is deposited in the bank? What kinds of penalties might I face if an auditor reviews this 2 to 3 years from now and determines I and/or my banker did this wrong?
I think we can probably all kick in with this. The one piece of the question was,
did we lose maybe Stephen for a moment here? We might have a frozen screen, at least it is on my side. So I'll pop in here. Really what's key is trying to keep documentation. We know that in the application materials, there are certain things that they say 3 years on, 4 years. IRS has a 6+ year look back period. So keep these documents. That's going to really help you. If you're under 150,000, the new 3508S form does give you a pretty good safe harbor on a lot of these things. As long as you're keeping documentation, you are doing your best to follow all of the rules. You're on the right path to being in compliance. Lindsay, is there something else to add in there, or for brevity purposes, does that kind of hit the main point?
I think that hits it in part because it's hard for us to know exactly how auditors may look at things. So, you know, the only thing I would add is the loan forgiveness, for example, the applications provide detail. I mean, you know, you'll want a magnifying glass, but they go into a lot of detail on the requirements for what documentation you need to keep and for how long. So if you're concerned about a few years down the road, I would really read your loan forgiveness application very closely and just be sure, as Megan said, that you're retaining those documents that support your PPP application and forgiveness.
I mean, the disaster is going to be if you don't have any records. And I mean, they're going to be very serious about that. If they pop up in a couple of years and say, well, we want to know, you know, how you reached this number, or you certified this or that, well, how could we know that that's true? You really need to have the records that you were asked to have in the very beginning. I mean, on one hand, this government is giving out billions and billions of dollars in COVID aid to millions of people. You sort of think, oh, for heaven's sakes, how could they really target me? On the other hand, you just never know. So keep those records. I mean, I just would not play games with these people because you could easily imagine them trying to pick out a few people and make examples of them. So kind of just go by the book and keep your records for the long term.
All right, so there was a question that Megan answered in the chat, but I'm going to ask it so that everyone can hear it. And it was about the 60% for payroll and the 40% on utilities, et cetera. Are those maximums or minimums? Do you have to hit them exactly for loan forgiveness?
Those are not things that you need to hit exactly. The 60% is a minimum, the 40% is a maximum for full forgiveness. And if you do go over that 40%, that just is going to reduce the amount of forgiveness proportionately. So it's not an all or none. And you do not need to have the employees be the same. That was a third part of that question. The question was, do you need to have the same individual employees in 2021 as 2019? And that is not the case. And Stephen did do a good job of mentioning that in the safe harbor amounts for FTE, full-time equivalent.
This is also related to, this is Teresa, this is related to forgiveness and was submitted prior to the webinar. For a sole proprietor, how is the forgiveness amount addressed since 100% forgiveness requires that 60% be used on payroll? And what suffices as documentation of that owner compensation?
Your owner's compensation in that case is your payroll. So you can, I have seen some places suggest, you know, write yourself a check. As Stephen mentioned, that is not legally the requirement, but it is just simply a calculation of your profits from your Schedule F. That is going to be your owner's compensation. And in the case of PPP, that is the same as quote unquote payroll.
Thank you.
Okay, can I use the PPP loan money to buy seed now for planting in spring? Can I use PPP dollars to buy shingles I'll use on a farm shed roof in spring because the shed roof is old, not because of riot damage or anything else? I assume I need to use the farm share of my electric bill, not including what is allotted to household use.
Okay, I'm glad you read this one out loud because I fear whoever asked this question, I'm sorry, I think I talked myself in circles in trying to answer it. And I think a few other folks have had a question on a category of allowable uses called covered supplier costs. I don't know if we lost Stephen, but I'm hoping he can chime in if he disagrees. So the category of covered supplier costs, and I want to read this from the rule because unfortunately, we don't have a lot of additional guidance on what this includes. The SBA says they are in the process of updating a Q&A that I expect to go into some more detail on some of these new categories of allowable uses, but they haven't updated it yet. So right now, the best I can do is tell you what the rule says. So under this rule, and this is speaking in part to your question on seed and potentially, things like shingles. So in order for any sort of expenditure on quote unquote covered supplier costs to be eligible as a use of PPP funds, you as the borrower must have spent that money to a supplier of goods in order to purchase goods that are both essential to your operation at the time that you have made the expenditure, and that expenditure must be made pursuant to a contract, order, or purchase order. So it appears there must be some, and order admittedly is a somewhat vague term, so I can't provide any more definition that's there. The other key things, so both essential and pursuant to some sort of order or contract. And the last piece is that that order or contract has to have been in place prior to the start of your covered period for your loan. So it needs to be in existence at any time prior. So to me, that suggests it could be months ago. Megan or Stephen, if you read things differently, please chime in. I think this is one of those gray areas that I wish I could give you a more definitive answer on right now.
Lindsay, you're really the expert on the covered supplier, so I defer to you on that new addition to PPP.
Is it forgivable
okay.
to spend 100% on payroll with more
Absolutely.
employees than 2019?
Oh, you've added a second part to that question. So you absolutely, I'll answer the first part first. You absolutely can go above 60% of your eligible use of PPP on payroll. That's the minimum. So using 100% for PPP, you are going to be right on track for full forgiveness. If you have expanded your workforce, you should, again, still be right on track for forgiveness. But whenever we add caveats and details, it's important to really look at the specificities in the context of your loan. And it's hard sometimes for Lindsay and me to give firm answers on things when there is a lot of extra details there, but you should be on track for full forgiveness.
Thank you.
And I think that original question, there was one other piece about utility expenses, and this could apply for other folks. So sorry, Jane, I'm just going to chime in. Yes, the only allowable and forgivable uses of the loans are those that are for business expenses. So it will get trickier, if they're, to separate household from business use. And I feel like there has been some guidance on that. If whoever wrote that question wants to email me, I will try to look for that guidance to give you a more precise answer. But the short answer is that the only forgivable part is whatever, portion of your electricity or utilities are used for your business and not your home use.
Thanks, Lindsay. Yep, that's really helpful. Here's a question. Did I hear it correctly that if I received a first draw loan and it was forgiven last fall, I can't recalculate to include gross income?
So yes, I think Megan appropriately added that in. Yes, any first draw loans that have been forgiven, you can't recalculate. The key here is to separate sort of these three tracks. So you have your first draw, you have the narrow ability in some cases to recalculate and increase that first loan, and then you have second draw loans. So even though you cannot, if your first draw loan was forgiven, you cannot recalculate that to include gross income. You may be able to simply apply for a second draw loan, and that would take into account, if you're a Schedule F filer, your line 9 gross income.
Okay, thanks. Teresa, is there another question you want to lift up at this point, or should we
I'll
close
I'll
out?
try
Okay.
this one. It may have been answered, but I'll do it again. If you got a PPP loan last year and are applying for a recalculation, do you still need to use the same tax form 2019, or can you use the 2020 tax form?
So I saw that question and wanted to get some input from Megan and or Stephen. So the rules for the loan increases, there is some guidance out. They're not extremely detailed. My best guess, so at this point, what we do know is that you can apply for the increase if doing so, if the new rules would allow you to have a larger PPP loan. Under the new rules, you can use 2020. I think I'm talking myself into circles now. I just don't know how lenders are going to approach that. I suppose my advice would be to talk to your lender.
I would definitely recommend talking to your lender. Remember, for a first draw increase, you're going back to that same lender. So they're going to have guidance for you on that. I would hazard a guess that that lender is going to have you do a 2019 Schedule F, but lenders do have delegated authority by SBA to have quite a bit of guidance on how they walk applicants through the process. Now, for your second draw, there things really open up. You've got 2019 or 2020 that you can use.
Okay, thank you, everybody. Thanks to Megan and Lindsay, and it looks like we've lost Stephen, but thanks to Stephen too for presenting on this. We did record this.